Good afternoon, and thank you for joining me. This is the first of our series of webinars talking about succession planning, and I'm joining you today from a not very sunny Truro. So thank you all for being here. We're expecting a big turnout today. In terms of the plan of what I want to talk about, quite a lot to fit in. I'm starting this webinar series with an overview one, which means it tries to cover pretty well everything. So there's lots and lots and lots to talk about. And so the key things that I really want to try and talk to people about here are what's at stake in terms of their business or business interests. Where does the money come from to pay the tax if they've got a liability? And what should you be doing now? Should you be making gifts? So really starting to raise some of the key things to kind of think about, other straightforward answers as to how to proceed. In terms of the other forthcoming webinars, as I say, this one is an overview which touches on a number of the different topics. I then have the very clever people coming after me who can do lots of different points in more detail or pick up more of the kind of subtleties and other points to understand. And this has been structured really with the next one being about, should we say, the more personal and financial aspects of it, the more private client end of the spectrum. So more about trusts, wills, the detail of inheritance tax, and about the financial planning solutions that could be used around that from our colleagues in Francis Clark Financial Planning. And then the one we've got coming up after that is more focused on the business side of it and what could be solutions in terms of that, and does this lead into exit planning strategy, and how does that fit in with other kind of restructuring ideas and family buyouts and the rest of it. And then we've got a further one coming, which is focused on the rural, on the farmers and the agricultural sector. In this webinar, I'm going to stick to business property relief, and the agricultural property relief would come into that final webinar that we've got lined up. So that's the plan. Thank you for being here. What's at stake? Should you be worried? So let's start there and see where we get to. So I appreciate that some people on here will know plenty about a lot of the topics here. Really, when I'm talking about what's at stake, there are three kind of aspects to focus on. One is the tax rules, another is the value of the business concerned, value of the business, value of the estate. And then there's also family aspects. And what this means is that things become very bespoke, very individual, very quickly. I wrote down you're all unique, so there's a takeaway for you. Everyone is different. It's an interesting kind of session here. So what factors have you got? Age of owners, state of health, family situation, existing structure. That existing structure may have been put in place for tax planning reasons, but it may be driven by many other commercial factors. So you've got all those different issues going on before you overlay the tax changes. And one of the big issues really with the way these tax changes are coming in is there isn't much preparation time for people to adjust to the impact of what's happening. And it may be for them that there's no real impact at all, and for others the impact may be quite dramatic. And that gets back to this, it's about individual circumstances. The purpose of this webinar really is to take you through so you can help on the thought process on your own position, your own business, and then think about how these points apply to you. So what have we got? Business property relief, what is it? It's a relief from inheritance tax on business interests. So going back to the 1970s, we're on a retro journey to there at the moment, but 1970s tax, the Labour government had capital transfer tax and was trying to pick up, and the Labour government was trying to pick up and tax people on transactions going on. And to begin with, business transactions were getting taxed, and this wasn't very acceptable and was damaging capital and businesses. So the approach that was then adopted was to bring in some relief for those business and agricultural assets. So we had business property relief and agricultural property relief from 1976. That's fair enough, and they were at a level not too dissimilar to where the government's aiming for at the moment, slightly less in fact. But then in 1992, they were made unlimited for the businesses that qualified. So broadly, if you had assets that qualified for a business property relief, you got 100% unlimited relief, which meant that they weren't subject to inheritance tax. And given that the assets also got rebased for capital gains tax on death, that's led to a very generous kind of position for the last 30 years, which frankly is as long as most people can remember or have been through in their kind of working careers. And has almost encouraged people not to do anything about passing businesses on in that way, because there's been incentive to hold things until death. So that's a position that we have. If you have investment businesses, so rental businesses, but also one or two other ones, things like kind of property dealing or share dealing, those are also excluded. But the vast majority of businesses generally will qualify for relief. Does depend how things are owned. So partnership and capital accounts get relief, sole trades get relief, shares in unlisted private companies get relief. You can have a position where you have some assets outside of companies in particular, like properties, or outside of partnerships, and then you get 50% relief. And outside of a company, you only get 50% relief if you've got a majority stake in the company. So you can have circumstances when you can fall foul of the rules that we've generally tried to pick up over the years and help people with. The main other exception you can get to is where people have got directors' loan accounts. They've lent money to companies, and that won't qualify for relief. So you could have someone who has got a decent sized company with assets in terms of it, relatively low share capital, heavily funded by a loan account balance, and they would be exposed to inheritance tax on that. What's changing then? Well, what's changing is 100% relief is going, or at least it's going above a certain threshold. What the government said in the draft legislation is that there's a threshold of £1 million per individual. It's not transferable between spouses, so each spouse has to use it themselves. And there are rules where if gifts happened before the 30th of October 2024, then they're within the old rules, and if they happen afterwards, they come within the new rules. This new £1 million allowance does get refreshed every 7 years. There's a whole load of more complex rules for trusts that are enough to make your head hurt, and keep us occupied and keep us busy for a while. And others, on the next webinar, we can talk some more about that. I've tried to keep away from trust quite a bit in here to keep this as accessible as possible, really. But what else have we got? Well, from April 27, so a year later, we've got pension funds coming into tax as well. And bear in mind, these rules could still change. They very possibly may change. We haven't really got time for a long ramble into what could happen, but I think the key ones to wait and see is what happens in the autumn budget, which the Times was suggesting could be 29th of October. And then they'll still need to go through Parliament, but Parliament hasn't tended to do much in recent times on tax legislation. I think it's possible that the allowance could be made transferable. I think the allowance could be increased from £1 million, but I think it's also possible that the 100% relief could be capped in some way, and that qualifying for it could be made more restrictive. So not the government giving away any of the tax revenue that it wants to raise, and very possibly the government wanting to raise more tax revenue, but that could change the focus. And that's something to discuss with your advisors in terms of how things could shift and whether that's relevant to you. So next point, I need to up the pace slightly. Next point is, what's your business interest worth? And we'll pick up a lot more on this on the detail. An awful lot of time is spent on valuation aspects. The difficulty here is that it's a theoretical and uncertain valuation. On death, what you're really talking about is the accountants, us, or the great experts sitting down and saying this is what they think a company or shares are worth, or a business is worth. Some of them you might have market forces. If you were dealing with businesses where there's a lot of property value or there's readily tradable kind of value, then you might have a market for it. But often it would depend, and it's a subjective kind of view. Probably now, the lower the value, the better for inheritance tax purposes than the way it used to be. But bear in mind that 20% of the shares in a company are not worth the same as 20% of their pro rata value. There are minority discounts that would apply where you've got a lack of control. And that's a key aspect to come through here. You also need to look at spouses as one block because of related property rules. And a lot of this can have other impacts as well. Yeah, there's a number of features here. Trust being particular one. Are trusts under control of one of the shareholders? Does that impact on the way you value the shares? Lots of different aspects. And there is a chicken and egg here. Formal valuations can be expensive. You can't really get any advice without a value to discuss the position. Equally, if you spend a whole lot of money on the valuation up front, do you then just find something and then find you didn't really need to do things in the same way? It changed your view. So broadly, in terms of any conversation you're going in with advisors on this, you need to think about a kind of range or an idea of what you think the business is worth. People can help you on that, but it's just, you need something for people to work with because it will make a difference to what is being suggested. So I've mentioned minority discounts. A lot of share structures can be much more complex. If the share structure is more complex, that will have an impact on how the shares are valued. Whether it has as much of an impact as people think will depend. So have you got votes on the shares? Have you got shares that only develop in value over time? Are they preference shares with minimum values but not so much upside? Have you got restrictions in articles or shareholders agreement? Articles will tend to impact on the value of the shares in a way that shareholders agreement won't, because it's a contractual deal between shareholders. So there are lots of factors that will determine how these things work. Bear in mind that it is the value just before death, and you could have a business that's heavily dependent upon the deceased, but it will be valued as if the deceased is still there. There is also a lot of scope for dispute between executors, the directors, the beneficiaries, and that needs thinking about. So as well as all the tax aspects, you do get to a lot of scope for problems to come along that when you're planning your estate or thinking what could happen are important ones to think about. Bear in mind that, as I'll come on to, if you're dealing with companies or partnerships, the money may very likely have to come out of that business, and that would be an issue for the directors. The beneficiaries may not be connected with that business. The executors may just be piggy in the middle. There's plenty of scope for difficulty here. So let's have numbers just to try and help people here to see what's going on. So I've got a value of business here, 2 million, 5 million, 10 million, and I'm picking an example of an unmarried business owner with no other assets. So not real world at all, no family complications, no other assets coming into it, but this is just about some numbers to get the hang of it. So what is happening here is, if we look at this business, 2 million, 5 million, 10 million, the individual is going to get 1 million at 100%. Let's assume there's been no gifts before. And then the balance is at 50%. And then you get to a value of the estate after business property relief, so taxable value after BPR. And then there would also be a nil rate band available as well. So that's the same that everyone gets, and there's no other assets here and it go against business. So what you see is that on lower values, the impact is more muted. So on 2 million of value, you've got 175,000 of the estate is taxable, 40%, about 100 grand or whatever. As you move up, not about 100, less than that. As you move up, you then get to 1.675, 4.175. So you're heading up quite sharply in terms of value that is then subject to tax. So the issue is much more as the businesses get more highly valued. So you can see that some businesses will, if we can keep the value relatively low or get them down, actually the problem might kind of go away. Whereas you get further up, you're not going to be able to just do anything with the value side of it. So enough of numbers and my inability to do quick mental arithmetic there. As we move on to some family bits here, let's talk a bit more about spouse exemption first of all. So one of the points here is that you've got a position whereby married couples, civil partners can leave assets between them and there is no inheritance tax on the first death. So this means that there is quite a lot of planning opportunity or opportunity to avoid a tax liability arising where you've got a married couple or civil partners. But it does depend upon the circumstances, how you deal with the business. It will depend upon the family situation. Are they both the parents of the children? Have you got multiple marriages? Have you got other factors to take into account? Have you got a big age discrepancy between the spouses? You know, that could have a bearing in terms of life expectancy, but it could also have a bearing in terms of likelihood of remarriage or something else happening afterwards. How are these shares held on an existing basis between them? And then, of course, there's all the relationship side of that, and all the points it comes down to, you know, how people run their lives, how their relationships kind of work. And you also need to think about, it's all very well if we say, well, let's only leave certain assets to a surviving spouse and then they can give them away. But where do they get their income from? Are they currently living off the income that comes, you know, off the joint holding of shares? So there are possibilities around in terms of things that can be done with a spouse exemption, quite a bit of possibilities, but also a lot of complexity. Then on the rest of some of the family ones, well, who inherits? You know, there's a recent report came out looking at the idea that actually farmers could afford the tax much more readily because there's more other assets in their estates. But it kind of assumes that everyone inherits an estate equally and that you can use non-business money to pay the tax bill on the business, and that doesn't cause any kind of issue. In many cases, you could have a desire to, you know, pass the business assets on to one child who's running that business or a couple of children. You might want to try and make sure there's some other money for other ones around. So you've got lots of different kind of family issues to consider. As I say, there are likely to be other assets in the estate. You need to think about the way pension fund assets are brought in. If you have got business assets within pension funds, we've now been told with the draft legislation that they won't get any relief at all. So that's not ideal at all. And then the complexities that come in with multiple relationships mean that trust arrangements are far more likely to be possible. And you may have challenges to wills under the 1975 Act. So this is nothing to do with tax. This is just legal matters where if people feel they've been disinherited or not treated fairly, making claims against the estate. So you've got all those kind of aspects to have to deal with and pick up. So what else do we need to think about in this kind of area? What does your will say? Now this is an important point for everyone to take on board, that we're accountants and tax advisors. We're not lawyers writing wills. But from what we've seen so far, almost all business owners need to get their wills reviewed and to be reconsidered. This is because the wills have largely developed and been written over the last 30 years or so in particular ways. And a lot of the typical will terms do not work very well with the way the rules are being rewritten. And this is just something that the professions are going to have to get used to and to adjust, and there will be solutions to it. But what you could have at the moment is there are a couple of obscure tax calculations. One of them is referred to as grossing up, both grossing up and double grossing up. Double grossing up is not twice as much fun as single grossing up, so don't get confused by that. There's also something called Section 39A spreading, and these are long-standing inheritance tax rules that we used to have to worry about before 1992, but have been largely academic for the last 30 years. What they can mean is that the tax liabilities may be different to how you might have expected. They might mean that different beneficiaries suffer the tax to what you might expect. I mean, that's a whole source of fraught difficulties within a family. If, little Johnny suddenly got Doris's tax bill, and it's just, something to have to consider in terms of the family dynamics. The other point is that if there is a lot of complexity around the estate and trying to get around different tax problems, and even just calculating them, there will be more cost, more expense. So what do you want to do? You want to make sure that ideally the 100% allowance is used by both spouses. I've suggested that figure might go up from £1 million. It may not go up as yet in the budget, but it might go up in future. How do you make sure wills are allowed for the fact that that could increase in future? How do you allow for some of the other factors that could come in? And these are things that the lawyers have been worrying about rewriting their precedents to kind of deal with. So one of the takeaways from here is, even if you think you don't have a big inheritance tax problem, you still need to get your will looked at and reconsidered. Right. Quick pause, draw a breath. So what I was trying to run through there was some of the issues you need to address in trying to assess what issues you've got. So you need to think about the tax rules and how they might alter even in future. You need to think about the value of the business, and of course the value of the business, how that might alter over time. Could be high now but go down in future. It could go up in time. Better to go up in time, but you don't know what could happen. And then there's family circumstances and how those family circumstances could change over time. One of the things that spent quite a bit of the past 9 months or more since these last autumn's budget is about how the tax gets paid. So in many ways, the issue that business owners need to think about is not just can they deal with and undertake planning action to avoid a tax liability, but if a tax liability is there, how do you pay it? Now, ideally, you want to deal with both of these, and you might want to be able to try and get rid of the liability and get it down as much as you can. But you need to consider where that money is coming from. And the reality is, it's probably going to have to come out of the business concerned. So there's a curiosity here that this is portrayed as a kind of personal tax problem or a private client problem in terms of the inheritance tax. And yet, really, the burden is very likely to fall on the business, and it's a business tax problem. And that in itself causes problems in terms of advisors and dealing with matters in the right way. So you've got a whole mixture of commercial, if you need to borrow money in the company, how do you borrow that? What rates are you paying? How do you deal with that? What securities do you give? Does that stop you investing in other things that you could have done? You've got lots of practical aspects in terms of just the mechanics of kind of dealing with that. And you've got a number of tax issues, most of which have absolutely nothing to do with inheritance tax whatsoever, and need thinking about, and the advisors need to make sure that they pick up, which may not have been their historic forte. And so if the business is unincorporated, matters are easier. So if you've got a partnership and you've got a tax liability on that partnership, you've got to find the money, but there is nothing stopping you taking that money out of the partnership. There is not a dividend tax rate or anything like that. You haven't got the wrapper around the business that you've then got a tax charge on taking things out. The higher value business assets, though, are most likely going to be shares. And if you've got shares, you've got much more problems in terms of getting the money out of the company to begin with. So that money is likely to come from potentially selling assets within a company. That could lead to capital gains in the company and corporation tax having to be paid on that. Or alternatively, it could come from borrowing against business assets, but in which case you need to think about, are you getting relief on that borrowing, and how does that borrowing work, and how does that come through? So there's those factors to consider. But then how do you get the money out the company? And if it's a dividend that you have to take the money out of the company, you're looking at an effective tax rate that's probably 65, 66%. So it's not a 40% tax bill in terms of how you pay it, it's 66. And that's because you've got to take money out to pay the inheritance tax, but you've got to pay tax on that money. Therefore, you've got to gross that up. That inheritance tax is the net. So you've got to pay tax on tax in simple terms. So avoiding getting stung with such a high tax rate becomes quite a key factor. Now, this might be much easier if you're the sole shareholder in the company in some way, but you might have other shareholders to have to deal with. You might have all sorts of restrictions around you. It's all very difficult. What are your options? Well, you have got the ability to pay over 10 years interest free, and that gives you breathing space. But if you've got to draw the money out as a dividend every year over that 10-year period, then you're just going to have to pay this higher tax rate over time. So that doesn't sound desperately attractive. The tax liability may be due by the executors or by the recipient of a lifetime gift. So one of the key points on some of this is who's got the liability, and that will depend upon whether you've made lifetime gifts. So if the shares are in your estate on death, the liability falls on your executors and they have to raise and pay the money. If I decide that I'm not going to hang on to the shares and I'm going to give them to one of my daughters and I die within 7 years, the inheritance tax liability arises on my daughter as a recipient of that gift, and she has to find the money. And that gets to different arrangements because she may have less options open to her, whereas the estate, we can generally make sure it's got more options open to it. You can do a purchase of own shares without the need to meet certain rules within 2 years of the date of death. It doesn't tie in with the 10-year interest free, but that's government's for you. You might be able to fund the tax from non-business assets, but as I said earlier, that raises its own problems in terms of who gets what. What we might often do is some kind of buyout of the shares from the estate by a new company and get statutory clearances. But there you need to consider something called the transactions and securities rules. And that's fine if the estate is disposing of all or nearly all of its interest in the shares. It doesn't work if the estate has got a large minority stake and it only wants to cash in some of the shares. So there's quite a bit of financial modeling to try and work out what's a good kind of position to be in. And it might be that, certainly giving all the shares away might seem like a simple answer, but often isn't a good answer. Equally, not giving any shares away probably isn't a good answer either. We may be able to do some restructuring to make sure we've got things like redeemable preference shares in the structure. That gives a good way of drawing money out at some point. There might be other types of arrangements around that. Insurance might work, but there are people that might have religious reasons why they don't want to use insurance. There might be other restrictions on using policies. If people are under 75, though, a relevant life policy might work very well and get tax relief going through the company. There's a lot of options, particularly for people in good health who are younger with more flexibility around. So there's a huge range of possibilities around insurance, which is a huge topic in itself. And we will pick up in the next webinar. So I've tried to avoid the subject of trusts, mainly because that's normally what I get requested by people on webinars and say, there's enough going on here as it is. Let's not complicate it too much. So I've tried to keep this quite simple, but we will have a number of clients, or there will be a number of people on here who've got existing trust structures. And one of the things that they will need to consider is what happens at forthcoming 10-year charge points. Now, at the moment, the way the rules work is that trusts are subject to inheritance tax every 10 years at 6% above any business property relief that's available and above the nil rate band. We've got a number of trusts that might have been set up where people have only put qualifying shares into them, often qualifying agricultural land. I know I said I wouldn't mention agricultural land, but it's an easy one to kind of get down to as well. There are trusts where there is no liquidity in them at all. So how do you get the money into them to pay the tax? What do you do? and what kind of tax liabilities are you looking at. And so again, you can see here that this is heavily dependent. I just picked the same 2, 5 and 10 million, and the values, crank up pretty sharply. So if you had to put money into a trust by way of dividend, that would be horribly tax inefficient. If it's a modest number, yeah, that's life. But you could get to some very painful numbers that would just be very, very difficult to fund. So then what's your options on that trust? Now, there are some quite useful transitional rules in the draft legislation. There are quite a lot of options and quite a bit of scope to restructure and replan how those trusts are being used, which is a whole, separate degree course, open university, early morning job in itself. So let's not, other than raising the problem, it's one to be aware of and to discuss with the advisors. Let's just wrap up on this section. So if we look at what could happen, what are the worst outcomes that you could kind of get to? Well, you could end up with executors holding shares in a valuable company with no plan on how to pay the tax. You could end up with death within 7 years of a gift of shares and no thought given to how the tax would be paid by the recipient of those shares. You could have a badly drafted will that really doesn't deal with the situation very well. And you could have claims coming into that state under the 1975 Act, probably because the will's not very well drafted as well. And depressingly, I see enough situations like that, and it really is not much fun. And what you need above all else, said the accountant, said the planner, is a plan to kind of consider how you manage this, because as ever, the key things about tax is how you fund, how you pay it, what options you've kind of got. You've then got, if you can pay something, there may be reasons why you can get around without paying it, but you want to put yourself in a good position first. The next point really to consider is gifting the answer? I mean, I'll pick up on a few other points here as well, but there's an incentive within where this government is going, which is a political viewpoint, a cultural viewpoint, which is that people holding large assets on one person is a bad thing, and that therefore what you want to do is to kind of spread things more across a family and break up business ownership or break up farm ownership or something like that. There's all the reasons why that's a problem, because businesses actually function better if you keep them together and don't break them up too much. But that's a kind of concept going through. And so there is an incentive at the moment really flowing through to say, well, give some assets away, survive 7 years, what's your problem type point. And in terms of looking at that, I'll pick up the way the calculations kind of work, and there's a lot of planning possibilities around here. The value of the gift is a difference in value of the estate before and afterwards, and I'll give you a quick example on that to try and make a point. If you make a gift, then for the following 7 years, you've got an exposure to inheritance tax, but there is a sliding scale as long as the gift is large enough to go above the nil rate band. So it's the tax that gets tapered, not the value of the gift. And there was some kite flying on the 12th of August by the government saying that they're going to look again at these percentages and how it comes down. So at the moment, the first 3 years, you're fully exposed to the tax, and then it drops from to 80%, 60%, 40%, 20%, and then you're out. So there's a sliding scale down. There's been a suggestion that the government's going to fiddle around with that. Perhaps they're going to fiddle around with it whilst also extending the 7-year survival to 10 years or something like that as well. Who knows? But at the moment there is a point here, which is if you start to survive more than 3 years, you've got some benefits in terms of how things are coming through. It must be an outright gift. There mustn't be any reservation of benefit, and reservation of benefit could well come into business arrangements. So, dealing with problems by saying, "Oh, it doesn't matter. We can always pay a salary," probably doesn't work. It depends. It might work. Yeah, it might work for a while, but it may not work forever. because you'd have to be able to commercially justify what's going on. And if you got my 93-year-old mum as a director, you know, with her care fees being paid by you putting it through pay as you earn, but she's never turned up to the business and not around, I'm not sure that's going to hold much water, kind of stuff. So the business arrangements and the commercials come into all of this, and that needs quite a bit of thought. And it needs an awful lot of thought that you may not have time to do if you're rushing around just trying to make gifts in too much of a rush. So, you know, there's an act in haste, repent at leisure type point there. Picking up on an example, as I said, the diminishing in value principle is quite important here. I thought this example might help, but let's see how it goes. So I'm looking here at someone who owns 60% of the shares in a business with a market value of £10 million company, and they want to give away 20% of their shares. So they're going to go down from having a 60% shareholding to a 40% shareholding. Now, a couple of factors come through here. I've started with a pro rata value. So their pro rata value before is 60% of 10 million, so 6 million, and their pro rata value afterwards is 40% of 10 million, so 4 million. So they've given away, you know, £2 million on a pro rata basis. Because of the way the discounts for lack of control work, I've used a couple of arbitrary ones here that are probably just about right. That £6 million shareholding is probably worth about 4.8 million before the gift. And the discount would go up because you get much more of a discount on a 40% shareholding than a 60% shareholding. And therefore, actually what you get is a much larger value of the gift than you may first expect. So the point that some of this is trying to get to is sometimes you don't need to make as big a gift as you might first think to make quite a big difference on the potential inheritance tax on your estate. Now, clearly going down from having a controlling stake to a non-controlling stake is a massive change for most business owners, but it's just considering how one might be able to do some of these kind of things. So hopefully that helps people understand that a bit better. The next point to pick up on, and I've left this at the 5th of April, which I appreciate is getting very dated, but this is trying to explain how the taper relief kind of comes through and the effective tax rate. And it's just easier to do it from the 5th of April as a gift. So yeah, bear with me. And the reason for that is I've tried to keep the years, so the 7-year period, I've kept it in line with tax years. So the 7-year goes from the date of whenever you do it. It's got nothing to do with tax years, but it's easier here just to show everything in terms of tax years because of the change on the 6th of April with the new rules coming in. So if what we had is somebody making a gift on the 5th of April 2025, excuse me, then for the first 12 months, you're still under the old rules effectively if they died, and therefore you get 100% business property relief, so there's no inheritance tax. So of the 3 years where you're fully exposed to inheritance tax, the first year you wouldn't have anything at all. After that, assuming the new rules come in as suggested, what you've got is £1 million allowance, and then 50% of 4 million, which is 2 million, gives you 3 million of business property relief. And so we've assumed, you fix the value at £5 million. So the value of a gift is the value as at the date of gift. So even if those shares were going up in value in future, you would be fixed at the value at the time. So in this case, after that, under the new rules, if they come in as suggested, we're getting £3 million of relief. You've then got inheritance tax paid. I'm ignoring nil rate bands, I'm ignoring other assets, just assume we've got inheritance tax being payable, and it's at 40% on the net of 5 million and the 3 million of business property relief. What I've then done with an effective tax rate is to take the taper relief into account, and you can see that before too long you're getting to maybe not, you might not view them as acceptable tax rates, but you can get down to things that are considerably better. And therefore, even if death occurred in the latter part of that 7-year period, you might go, yeah, we can cope with that. It also means that you could look at possible solutions where you insured for some of the time, but not all of the 7-year period potentially, or where you part insured some of it and you said, well, we'll take the risk and self-insure on some and insure on the rest. So you need to understand the way the numbers work. And going back to what I was saying earlier, you've got to give the accountants or the advisors some numbers to work with in order for them to be able to flow through and say, okay, here's what it might look like. And it's only when you start to get down to here's what it might look like and here's what the impact might be on your family, on the estate, that you can, begin to plan really what's going on and to appreciate what the impact is kind of for you and your family. So there are other taxes to consider. The two main problem ones to be aware of are capital gains tax and then employment income taxes. There are a number of different taxes that could apply, but these are the two that probably occupy the most thought around it. The danger is that if you the way the rules work at the moment is you've got 100% unlimited business property relief and you get revaluation as at the date of death for capital gains tax purposes. You get revalued to probate value. So there is an incentive to hang on to assets until you die because there's no inheritance tax and the asset gets revalued. If you give the asset away in your lifetime, then you don't get that revaluation on death. Now, you might have something called holdover relief that would enable the capital gain to be held over. And if you pass it on to, let's say, a child and they never ever sell the asset, then who cares? But if the asset is sold subsequently, then you would have a capital gains tax liability. So the danger is that by making gifts, you could end up with both capital gains tax and inheritance tax. And holdover relief may not be available, or if it is available, it may be restricted and it may not be unlimited. And the rules on holdover relief are not very nice. They're dated and the government could do with revising them, but they don't seem minded to kind of do that. So they're not very business owner friendly. So there is a distinct problem that you could do something and you could be worse off. And that is something that one has to kind of go through and crunch the numbers. And again, gets down to there could be a balance around there. Please also bear in mind that the valuation for capital gains tax purposes is not the same valuation method that's used for inheritance tax purposes. The other problem case that we have is employment taxes. Now, in particular, we've got things called the employment-related securities rules, which are taught to us, but are designed to catch as many situations as possible. And in particular, could be a problem if you tried to get clever with the share classes and create, let's call them funny shares or things that go up in value in due course. There are exclusions for arrangements amongst the family, but they're quite tight restrictions. And there's just quite a lot of complex stuff to have to consider there. You might manage to do arrangements within trusts where you've got shares held in trusts and dealing with it that way, but you could still come within disguised remuneration rules, which were brought in to counter people using employee benefit trusts to reward people. And so they're designed to catch some of those situations. So because some of the planning that is being suggested and might be effective in many cases for inheritance tax has been used over the past 30 years by people in the city, mainly, but also footballers and some others, to be rewarded tax efficiently with rules having been brought in to stop them. There are income tax rules that could impact. So the inheritance tax advice might say, well, there's no inheritance tax liability, but you could still have a big income tax charge, all of which would be deeply unpleasant. So there are pitfalls that you need to be very aware of. As I say, the next webinar, and I'm almost at the end of my kind of bit here and almost getting to a wrap up, but the next webinar will pick up on insurance matters far more, but just as a kind of quick run through in the same vein as the points before, there are a number of different types of insurance. So apart from the individual circumstances and the different impacts depending on how much you're trying to insure and what your state of health is and what underwriting the insurers may wish to go through, you can do things like inter vivos on a gift, which is decreasing down over the 7 years in line with the taper relief. So it's just designed to kind of pay out the inheritance tax that you might otherwise suffer. You could do term insurance, which is fixed for a certain period of time. You could do whole of life that will carry on for your life and could be guaranteed rates or could be minimum or balance rates and rates that go up over time with 10-year reviews. There are lots of different possibilities, and it is important that you get independent and good advice on the possibilities that are there. Don't jump to conclusions without understanding the different possibilities that are there. That needs to tie in with the tax and legal advice. See far too many cases where different people have given advice and it just does not join up at all. And therefore you've got to get something where the bits tie together and people understand how the other elements work. And you might think that's quite easy, and sometimes maybe it is, but often it's just a bit tortuous. And so if you have things like shareholder protection, where you might have policies paying out to give people money on death, how do they deal with value? How do the valuation clauses come through? How do they get revised? What's been done about there? So lots of kind of things there. Number of people feeling that insurance might be the answer, but how do you pay the insurance premiums? Will you carry on paying them? Where does that kind of go? And then also, how does that work if the estate's a beneficiary, but the tax is due on the recipient of the gift? So there's a lot of planning around who ends up with what. So as a point to wrap up, in terms of, I've called this how to respond to the new rules. I think number one, there are tougher times ahead. It's the rules are not finalized yet. I think things could still shift. I think things could still shift over time. They might impact you slightly differently if they change. It's hard to believe they're going to suddenly be wonderful and go back to where we thought they were before autumn last year. The key things you need are a plan and a strategy, and this needs to be for companies and for larger companies. It needs to be on the FD's kind of list of problems to have to deal with, and companies need to think about their shareholders' position if they don't want to get caught out with problems coming along they didn't expect. And whilst it's easy for me to say you should get advice, because that's always the best way to finish a webinar, we're here and we're happy to help. That's what we're in business to do, all of those things. It is very hard to generalize on these points. There is so much that is based around the nature of the business and based around the nature of the family circumstances that you need to have advice that is relevant to you. There is quite a bit about how you access that advice, and we're very happy to meet your needs and to kind of have sensible conversations around it. So the danger is you lunge into too much detail and get stuck in trying to answer every problem under the sun. That doesn't really help. There's a starting point, much like the way we're approaching these webinars, which is really trying to say, okay, what's the position now for you? Where are you at? What's it going to look like? What do you need to think about? What are your issues? And that's the best place to start, and that's best held. Okay, some of it can be done in letters, but a lot of that's just best held in a conversation with someone you trust to understand and to have that conversation with you. And with that, I didn't mention the polls earlier, having been instructed to mention them, but we put a couple of polls up. that for you to give us some thoughts on how you're approaching these issues and whether they're causing you any concern, and what actions you take to plan to date. And if anyone has any questions, also be happy to receive some questions. And there are some questions. So there we are. I was going to say, yeah, it's up to you as to where you go. So I will start looking at the questions, and hopefully the polls are up as well. So right, and some of these questions have been answered. So slides will be available afterwards. So that's good. Just panning down here. So one question I've got at the end: for family businesses where there is a plan to pass on to children in a straightforward arrangement, is the main principle in responding to the changes about looking at gifting shares to those children slightly earlier in life rather than waiting until death? That's a perfectly reasonable strategy. I mean, the logic being there that you gift the shares in good time, such that there's a reasonable prospect of surviving the 7 years. But even in that circumstance, you've still got a point here, which is, well, do you insure for that 7-year period? You know, how do you kind of cover off the risk there? And if people have shares that they are getting dividends on that they give away, how do you make sure they've got money coming in? And one of the historic answers we used to do for this is to make sure that people had reasonable pension funds, and therefore they were drawing down on their pension and they had an annuity in payment. And because they were in receipt of that annuity, they could pass on their shares, and that was all fine. Even after George Osborne messed around with the rules, we got to a position whereby, you know, that fund was not taxable. And so, you know, you had that option. But here, if you gift on earlier, you would have to consider the income point. And as I say, that can work fine if people are still working in the business. But if you're then worried about getting to a point in time where they're no longer working in the business or no longer able to, you've still got to have a solution for that. So I think in short, yes, I mean, it's a perfectly reasonable strategy. You know, we're not looking to find problems where there aren't problems, and many things might work quite well for people. But there's just a lot of practicalities to think about. And that's even before you get to, you know, relationship issues for children. How do you protect those assets? Do you want to put them into trust? You've now got problems if you try and put them into trust. What happens in terms of shares being passed down to the generation beyond? What happens if one of those children says they're interested in the business but is less interested afterwards? What happens if you've given shares to the children that are interested in the business, and then a child that says they weren't interested becomes more interested? Yeah, just all of the world of just life that, you know, keeps us employed as a firm of accountants as well. But I'm not knocking that part, but there we are. Right. Unless anyone has any other questions, I think I'm getting towards the end of the time. And anything else? Yes, a few more coming in. Which country should we move to? Well, you could go somewhere warmer than here. I quite like it here. There is an interesting point on the escaping inheritance tax, that historically it has been very, very hard to escape inheritance tax because we had a domicile system. This government, really the end of the last government, decided to dismantle that domicile system. And that has made it much easier for people to move and to leave the UK and to escape inheritance tax. And I suspect, yeah, I'm not sure how long the system we've got at the moment survives on that basis, because, you know, the historic arrangements worked very well for a couple of 100 years. So there are options of where you could move to, but you have actually got to want to live there. And what's the point of having lots of money if you can't live where you actually want to live? So maybe it suits you and there are places you go to. we have, as you can imagine, spent a huge amount of time of late trying to deal with advice on people going, overseas. Is a family investment company a better way to go rather than trust? Not necessarily. There's different pros and cons to each. Very, without making it sound too complicated, very possibly both is an answer. You get down to, you just need to consider the possibilities there. Equally, I can say both is a better answer. Depending on the values concerned, all it does is ladle cost onto things that you don't need. Somebody asking, what can you do with shares gifts if your children are 14 and 16 years old? Yeah, I mean, it's difficult on many levels. I mean, I would tend to hope that insurance is a better route to head down at that point. That feels like maybe a more promising way to kind of consider. But that's something to kind of look at. There are difficulties where you have got minor children involved, and remember, there are all sorts of problems that could be caused by giving young adults very valuable assets that you may not fancy. Further question: for an over 75-year-old with £4 million worth of pounds worth of shares in a property investment company that's tenants in properties, is the only way to pay the CGT sell the properties that brings with it a corporation tax liability? I mean, we're wandering off kind of there. There are structures we can put in place to restructure shares, but yes, if you needed, I think if that's saying if you needed to get the money out of a property investment company, you could be in danger of having an absolutely obscene tax rate if you're not careful, because you could get down to a position whereby you've got inheritance tax on the shares not qualifying for any relief at all. You then need to sell assets in a company and pay 25% on that, and you then need to pay dividend tax on taking that money out of the company. I mean, whichever country somebody wanted to go to earlier, you just be heading off there and thinking, why did you bother? And that feels that can be improved upon, and is something to kind of consider. For badly drafted wills, would a deed of variation still be an answer? Possibly, but I was with someone a week or two ago where it wasn't, because it was leaving everything to a spouse, absolutely, and therefore the spouse, if the spouse did a deed of variation, that would be a settler interested trust. You've still got the point that they would be the settler for income tax purposes, and then the arrangements don't work in terms of income tax planning. So I think you can use deeds of variation to try and help, but my view would be people are better off having a conversation with good lawyers who know what they're talking about on this, and just getting something better put in place. I appreciate the nobody, I don't think anyone wakes up in the morning and goes, wow, I really must redraft my will today, that feels exciting. So I get that point, and I also get that it feels like a bit of a grudge purchase and doesn't feel like money well spent. But I would say for most business owners at the moment, even shelling out a few £1,000s on getting wills sorted out is probably a very wise piece of insurance, to give them the maximum amount of flexibility. So another question: who is it that would take the insurance out? Would it be the company, the shareholders, or the beneficiaries? I mean, that's it could be different people for different circumstances, and that gets down to the overall strategy. So if we came up with a plan whereby an estate held on to shares with the intention that the company would do a buyback, the company might then want to insure to be able to buy those shares back. I mean, you get to different rules on who might get tax relief on insurance premiums, but that's one kind of option you could get to. The deceased might have insurance running that's written in trust and going to the executors. A recipient might, want to insure or kind of do something there. You've got issues as to who's got insurable interest and what they're insuring for, but there are different options that could be considered. Okay. You are mentioning will. Should we all have business lasting powers of attorney as well? Yeah, probably. Sorry, we get into. I'm sure my advice is meant to be yes. You probably should. Some people have still got old school enduring powers of attorney. The modern lasting powers of attorney are split between financial interests and health issue interests. They're almost certainly a very wise thing to have. Whilst I said the wills weren't exciting, I mean, I struggle to get too excited by those. I think, the lawyers, if they were speaking on the call, would be shouting, yes, you do need to. And I think these are all things to consider. One of the points that we also spend quite a bit of time with some people who may be in a terminal condition as well, or even other people planning their estate is, well, who are the directors of the company going forward? Who's running it? Have you got a decent succession on that level? These are all practical things to need to consider, and they're all better if people discuss them and consider these points. Right. Only 1 minute past 1. And then someone's asking me exam questions now. My client's granted a new agricultural tenancy as a second succession by negotiation under AHA 1986 with a commencement date of 29 September 2024. As the proposed changes to HT stand post May 26, what level of APR will be available for the value of the tenanted holding above 1 million? I mean, I feel some of this is, I mean, my immediate reaction is that goes back to being 50%, but I wasn't expecting that question today, and I think that's probably one to pick up, more separately. And I might say we've got an agricultural webinar coming up. So, and perhaps on that, since we seem to have moved on to AHA successions, I'm going to bring this to a close before too long. When do we get the slides, and is the recording of your talk included with the slides? Now, that's a complex question. I think they will be emailed around afterwards, and there will be an opportunity. I think what we'll probably give you is a link to a recording. My guess is it will be a YouTube one, and that you will be able to pick up on YouTube from there, as things are. Right. Thank you. Numbers are dropping a bit. I think I've gone on too long. Thank you all for your time. I hope that has been helpful, and I hope you tune in to the webinars coming up, and there will be more opportunity to ask questions on those. Thank you very much.